Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal: Controversy follows Polymarket. Polymarket's markets suggested Trump was likely to win, right up until the election. That accuracy from a crypto prediction market drew billions in bets and celebrity backers. But it also drew regulators, FBI raids, and accusations of manipulation. This is the story of a startup that turned crowd wisdom into a business, until the government decided it looked too much like an unregistered casino. This is from the Wall Street Journal, and it's about the collision of innovation, politics, and regulation. Shane Copeland built Polymarket into a prediction powerhouse, but controversy follows because the incentives don't align with traditional finance rules. Shane Copeland is the central figure. He's the founder, the dropout entrepreneur who launched Polymarket in 2020 after a failed crypto venture. He's the builder who pivoted to prediction markets, raising a $4 million seed round and pitching it as a future $100 billion company. He's the allocator betting on crowd wisdom over experts. He's the constraint, dodging regulators while growing volume. What worked for a long time was the core idea: list contracts that pay $1 if correct, $0 if not. Prices fluctuate with trader views, implying probabilities, like 41 cents meaning 41% chance. No fees on most markets to attract users. It harnessed wisdom of the crowd better than polls or pundits. What quietly stopped working was operating offshore while Americans used VPNs to bet anyway. The open secret became a problem when volume exploded. The inflection point hit in spring 2024. Past. Grow fast offshore, settle CFTC fine in 2022. $1.4 million, no admission of wrongdoing. Ban U.S. users. Present. U.S. Attorney's Office, Southern District of New York, opens criminal probe. Suspicions: violating anti-money laundering laws, unlicensed money transmitter by serving Americans. Biden's June debate flop triggered bets he'd drop out, spotlighting Polymarket. Republicans warmed to it. Copeland photographed at RNC with Don Jr., Omid Malik of 1789 Capital, David Sachs. Polymarket's election markets favored Trump. Investigators expanded to wash trading, traders moving assets back and forth to fake volume. Columbia study, co-written by Rajiv Sethi. Signs in 25% of volume. Polymarket prohibits it but lacks KYC for most users. The visuals scream growth and regulatory risk. Polymarket dominates volume but faces bans everywhere. Capital allocation autopsy. CFTC settlement 2222. Expected fines. U.S. ban. Happened. Opportunity cost. Slower U.S. growth. Trade-off. Offshore scale. 1789 Capital invests pre-election. Undisclosed. Post-win with Don Jr. as partner. At least $10 million total. Timing. Post-debate surge. FBI raids Copeland post-election Las Vegas Trump donor meeting. Delayed from pre-election to avoid optics. Battering ram on door. Polymarket calls it political retribution. Lawyers, Orrin Snyder, accuse Biden White House influence. Trump admin dials back crypto enforcement. Lawyers lobby Deputy AG Todd Blanche. Prosecutor Nicholas Roos shelves probe July 1st, citing Polymarket docs and DOJ policy. Copeland celebrates raid anniversary on X with cake. Cheers to free markets, the American dream, and $3,000/HR lawyers. Polymarket has high valuation, almost no revenue, zero fees to grow users. Competitors like Kalshi, regulated in U.S. Polymarket offshore, drew Americans via VPNs. Open secret. Manipulation risks. Anonymous traders. No KYC. Disputes over resolutions. Wash trading 25%. Suspicious bets before events. Signal versus reputation. Accurate election odds, Trump win, burnished cred, but regulatory shadows lag reality. Lessons. First, incentives clash. Founders like Copeland chase growth, ignore borders. Regulators see gambling, AML risks. Crowds bet skin in game for truth. Anonymity enables abuse. Second, scale invites scrutiny. Volume to 4 billion draws FBI, DOJ. Success plants failure seeds. Offshore workaround works until it doesn't. Third, systems must evolve beyond creator, Copeland's vision. Billions using it for policy, truth. But without KYC, resolution trust, it's casino. U.S. platform launch is step 1. The core question: can Polymarket survive controversy to become truth oracle? Yes, if it navigates politics, adds KYC, monetizes without killing growth. One sentence: in prediction markets, crowd wisdom meets anonymous chaos, and the builders who add transparency will compound while the wild ones implode. Moving to next title, I tested a Chinese-made EV and now yearn for my own. The Chinese are the 700-pound gorilla in the EV industry. When the CEO of Ford says that, you pay attention. Jim Farley isn't talking about a theoretical threat. He's reacting to something he's felt in his hands and under his right foot, a Chinese-made electric car that he, personally, didn't want to give back. The Wall Street Journal ran a personal technology column where Joanna Stern spends 2 weeks with a Xiaomi SU07 Max around New Jersey. On the surface, it's a love letter from a journalist to a car she can't buy in America. Underneath, it's a case study in how a new entrant, backed by a consumer electronics founder, can out-execute legacy car makers on the dimensions that actually drive long-term value: software, integration, and cost per mile. Let's treat this like investors, not as a car review, as an early glimpse of where the compounding will happen in this industry. The central figure behind this story isn't just Joanna. It's Lei Jun and Xiaomi. Lei Jun built Xiaomi as a tech company first. Phones, tablets, a whole hardware ecosystem. Now that mindset is being poured into a car. The SU7 Max feels, in Joanna's words, like what you'd expect from a tech company making a car, not a car company making tech. That distinction matters. Founders like Lei Jun are builders of systems. He's building an ecosystem where the car is just another node, the 16.1-inch HyperOS infotainment display, the Xiaomi 17 Pro Max phone mirroring directly onto the center screen, the tablets that lock into the backs of the front seats, the Bluetooth karaoke mics, the long-range walkie-talkies, even the mini fridge that docks between the rear seats. He's also the allocator, directing capital into battery range, software polish, and accessory ecosystems instead of just sheet metal and brand. The result? An EV that in China launches around 299,900 yuan, roughly $43,000, with a claimed range of about 810 kilometers, close to 500 miles. Similar sticker to a Tesla Model Y, a very different experience. And he's the constraint, because Xiaomi right now is effectively blocked from the US market. Tariffs, security restrictions, and politics keep the car physically out, but the idea is already inside the heads of US consumers and executives. For a long time, what worked in autos, especially in the US, was hardware first, software second. You picked your badge, your engine, your trim. Infotainment was an afterthought. The software felt like a 5-year-old Android tablet bolted to the dash. Buttons and knobs were familiar, but nothing felt integrated. EVs came along and Tesla flipped that script. Big screen, over-the-air updates, software at the center. But Tesla and others also went all in on touchscreens, ditching physical controls. Joanna reminds us she complained loudly about Tesla and others for that. All touchscreen everything, no knobs, no buttons. You could either have modern or usable, but not both. Quietly, that stopped working. People got tired of laggy screens. They got tired of jabbing the display 5 times to load a map. They got tired of hunting climate settings in submenus while driving at 70 miles an hour. And at the same time, Chinese companies quietly built something else. The Xiaomi SU7 Max is that something else. Joanna's description is vivid. She climbs into her usual Ford Mustang Mach-E now and can't stop thinking about the Xiaomi, the long range, the modular interior, the absurdly large screen, the adjustable color lighting at night, the wireless karaoke mics on weekends, the walkie-talkies so the kids can hide under the bed with them, and the backseat mini fridge. This isn't gadget creep. This is an integrated product strategy. On the screen in front of you, picture the SU7's cockpit, a wide 16.1-inch display floating above a minimalist dashboard, HyperOS running smoothly, no lag. Icons gliding like a brand new smartphone. Under the screen, a slim control bar snaps into place magnetically, physical buttons for volume and climate. To the rear, 2 tablets are docked behind the front headrests, facing the rear passengers, acting as full tablets and as climate controllers. In the center of the rear seats, a compact mini-fridge locks onto the tunnel hump. That's what investors often miss. This is not about one feature, it's about an architecture designed from day one to be modular, to be upgraded, to be monetized. Xiaomi's advantage is that it already runs an ecosystem. So when Joanna says the magic is for people inside Xiaomi's universe, she means your Xiaomi phone mirrors directly on the main display. Your Xiaomi tablets become in-car rear seat entertainment and control panels. Your karaoke app, your mics, your walkie-talkies all speak HyperOS natively. It's what Apple would have done if it had shipped the rumored Apple Car and everything just worked. The inflection point shows up when she drives it. She compares it to her own Mustang Mach-E and a Tesla Model Y she tested years back. The SU7 Max sails smoothly and quietly, somehow feeling sportier than both. She can't test full self-driving because of the language barrier, but she gets the advanced driver assistance going on a trip into New York City. The car brakes, steers, and accelerates more smoothly than her Ford. Battery performance is where the capital allocation shows. On a very cold day, a scenario that normally punishes EV batteries, she does a 50-mile round trip and uses no more than 30% of the charge. Xiaomi claims that 810-kilometer range, roughly 500 miles, on a full battery. Whether that's on a specific test cycle or not, the lived experience is clear. It's materially better than what she's used to. She charges it at home using her existing Level 2 charger with an adapter. This is where copying the past fails. If you're a US automaker trying to bolt on software at the end, you're competing with a tech company that's treating the car as another edge device on its network. If you're Tesla, believing your initial advantage in software is permanent, you now face a competitor whose OS feels like your phone, not like a reskinned browser. And if you're an investor who thinks tariffs and regulation will protect incumbents indefinitely, you're ignoring how mobile that design playbook is. You can block imports. You can't block ideas. Let's walk through the capital allocation decisions embedded here. First, Xiaomi's battery and range bet. What was expected in the EV race? 250-350 miles of real-world range, with cold weather knocking that down sharply. What Xiaomi actually delivers, at least in Joanna's usage, is a cold day 50-mile round trip on 30% of the battery. That implies meaningful headroom. Opportunity cost: batteries and power electronics are expensive. That capital could have gone to marketing, to design flourishes, to chasing status. Xiaomi allocates it to range. The hidden trade-off is that you're competing directly with Tesla and BYD on the hardest part of the stack. But if you win, you're not just selling an EV, you're selling relief from range anxiety. For long-term compounding, that's the right lever. Second, Xiaomi's software and hardware integration. What was expected? EVs with modern-looking screens but old, clunky software. Instead, HyperOS behaves like a flagship phone. Apps load instantly. Apple CarPlay looks beautiful on the big screen. Navigation directions play just in the driver's headrest speakers, while music continues everywhere else. Xiaomi chooses to sell a slim control bar that magnetically snaps to the display, bringing back physical buttons for volume and climate. They spend capital and BOM cost to give you both, touch and tactile. What actually happens is that the car feels less like a compromise. The opportunity cost is complexity. Hardware SKUs multiply. The hidden trade-off is that most OEMs don't want that complexity. They want to standardize and strip costs. Xiaomi is betting that better user experience compounds over time into higher willingness to pay and higher customer loyalty. Third, price and market positioning. In China, the SU7's launch price starts around 299,900 yuan, about $43,000. That's Tesla Model Y territory. Yet Joanna says the Xiaomi experience feels more premium. What would it cost in the US? Analysts tell her it would be higher, and right now there's a 100% tariff on Chinese-made EVs, plus federal restrictions on Chinese connected vehicle tech. So the company can't just ship SU7s into New Jersey. The environment is the constraint. On screen, imagine a simple mental chart. One axis is battery range. SU7 Max sits near 500 miles claimed. Model Y and Mach-E sit meaningfully lower. Second axis is software integration. Xiaomi is at the top, with phones, tablets, accessories integrated. Tesla in the middle with strong in-car software but weaker broader ecosystem. Legacy OEMs lagging. Third dimension is price. SU7 priced roughly in line with Model Y in its home market. Now, politics. Trump visits Detroit and says Chinese automakers would be welcome if they built cars in the U.S. with American factories and workers. Let China come in. That's not a concession, that's a blueprint. Michael Dunn, an auto consultant, is blunt. He says you absolutely will get a car like the Xiaomi SU7 here, no question. Chinese manufacturers are prepared and poised to pounce as soon as the door opens, and that door opens not through imports but through manufacturing here. He's also careful. Xiaomi itself says it has no current U.S. plans. That's what an option looks like. Xiaomi doesn't need to commit today. The script is obvious: joint ventures, local factories, U.S. branding layered on Chinese tech. Time is on the side of the company that's already built the product. Reality check for investors and operators. First, the reliability caveat. Analysts tell Joanna we don't yet know long-term reliability or safety performance for these cars. She's honest. To be a serious customer, she'd need more data. But her impression from 2 weeks is that this is a well-designed, well-constructed vehicle. As investors, we have to hold both facts: short-term product superiority, long-term durability unknowns. Second, the tariff air cover. A 100% tariff plus tech restrictions feel like a moat for U.S. OEMs. They're not. They're a timer. They buy time. And Farley is using that time. Ford is rebuilding its EV lineup, starting with a $30,000 pickup explicitly to compete with what they've seen from China. That's a capital allocation decision. Retool product to fight the real enemy, not the incumbent across town. Third, consumer expectations. Once a critical mass of reviewers and executives experience a car like the SU7 Max, the bar moves. Joanna describes going back to her Mach-E and seeing only what's missing. That's how disruption feels from the inside. It's not a spreadsheet. It's the sensation of going backwards every time you use the incumbent product. 3 lessons I'd take for long-term investors. Lesson 1. Incentives shape where the magic happens. The core question this Wall Street Journal piece raises is simple. In a world where EVs are becoming rolling smartphones, who compounds more value over the next decade? The car companies trying to learn software, or the software and device companies learning cars? Everything Joanna describes in that Xiaomi SU7 Max suggests that the compounding engine is installed in the tech-first camp. The only real defense for incumbents is to start thinking like Lei Jun. The car as a node in an ecosystem, not a metal box with an afterthought screen. And the sentence I'd remember is this: when a $43,000 Chinese EV feels more like your best smartphone than your best car, the real risk isn't that it never reaches America, it's that your existing portfolio is moving to next title, The Economics of Hip-Hop. Hip-hop has been the soundtrack of my life. That's how Roland Fryer opens in the Wall Street Journal, and it's the right place to start, because he isn't writing as a detached critic, he's writing as someone who grew up with Run DMC in his headphones, Dr. Dre rattling the rearview mirror of a beat-up Monte Carlo, and Killer Mike in his ears today. This isn't an abstract culture war argument. It's a serious economist trying to answer one question: what has hip-hop actually done to the lives of the people most exposed to it? And that question matters because whenever outcomes get worse, crime, schooling, earnings, there's a reflex. Blame the culture, regulate the expression, go after the music instead of the underlying economics. We've seen that pattern over and over. The central figure here is Fryer himself. He's not a founder in the startup sense. He's a builder of empirical systems. He and his team spent a decade constructing the equivalent of a business data warehouse for culture. Radio station logs from 1985 to 2002. Billboard Hot 100 data from 2000 to 2024. AI digitized playlists. Word-level text analysis on hundreds of thousands of songs. That's infrastructure. That's capital allocation, academically speaking. He's also the allocator of the questions. Which variables matter? Exposure by county over time. Types of hip-hop: street, conscious, mainstream, experimental. Outcomes: crime, education, employment, earnings, teen births, single parenthood. He's taking the mindset we usually reserve for studying companies and applying it to a genre. And he's the constraint, because he forces himself to fight both ideology and the temptation to read meaning off a time series chart. Crime up and wrap up at the same time? That doesn't prove cause. That's like looking at GDP and smartphone penetration and declaring phones cause growth. For a long time, what worked in the public conversation was moralizing. Critics like Geraldo Rivera said hip-hop had done more damage to black Americans than racism. Teachers and civil rights leaders argued that lyrics glorifying violence, misogyny, defiance of authority, and casual use of slurs must shape behavior. On the other side, artists framed hip-hop as journalism, the CNN of the hood, as Chuck D put it, documenting reality rather than creating it. What quietly didn't work was getting any closer to the truth. The methods were too crude. Lab experiments like Craig Anderson's showed that violent lyrics can momentarily increase aggressive thoughts. Short-run priming effects. But that tells you almost nothing about 20-year trajectories in real people's lives. So Fryer does what a value investor would do when the narrative is noisy. He goes to the data. He and his team build a diffusion model of hip-hop from the late 1980s onward. They map exposure across virtually every U.S. radio station between 1985 and 2002. They layer in Billboard Hot 100 data from 2000 through 2024. They digitize station playlists using custom AI tools. Now they know what different parts of the country actually heard in a given year. Then they classify the product. Hip-hop is split into 4 broad categories: street rap, hustling, street life, Dr. Dre, Tupac, conscious rap, political themes, social injustice, Kendrick Lamar as a modern exemplar, mainstream rap, radio-friendly, broad appeal, experimental rap, pushing stylistic boundaries. What did people really hear on the radio? At hip-hop's peak on radio, from the late 1980s through the early 2000s, mainstream rap accounted for nearly 90% of rap airplay. 9-0. The harder-edged street rap that fuels much of the moral panic was present, but far less frequent. Its share and its cultural influence grows later, especially after 2010. But if you grew up thinking radio was wall-to-wall NAA, the data says no. It was mostly mainstream. Inside the music, the lyrics changed. Over the past 40 years, their text analysis shows profanity, violence, and misogynistic language increased roughly 5-fold. References to drugs rose by about half as much. The music got more explicit. That's a real shift in the product. It helps explain why anxiety never goes away. If you only look at words on the page, the trend is ugly. But for an economist, that sharpens the question instead of answering it. If the content intensified that much, did outcomes in places with more exposure deteriorate more? This is where the inflection point in the research design matters. Hip-hop didn't spread uniformly. It reached mass audiences first through a subset of black radio stations formatted as urban contemporary. Some cities had those stations, and they had signal reach and local history that brought hip-hop in early. Others didn't. It's geography, tower patterns, and programming histories, not teen attitudes, that created the initial uneven rollout. That's the natural experiment. Places with early access versus late access. Fryer's team uses radio data and decades of census records to estimate, for each U.S. county, how much hip-hop was played on the radio over time. Then they ask, when hip-hop penetration rises in a place, do crime trends shift relative to elsewhere? Do cohorts who were teenagers in high-exposure eras end up with worse education, employment, earnings, teen birth rates, single-parenthood rates? The answer they get? Effects hover around 0, sometimes even slightly positive. Counties with heavier rap exposure don't see higher crime relative to trend. They don't show lower educational attainment. They don't show weaker labor market outcomes compared with similar places that got less exposure. That's the reality check. It's counterintuitive if you've spent decades hearing that rap is corrosive. But it's perfectly consistent with the idea that culture is reacting to deeper economic forces, not driving. One map shaded by early hip-hop exposure, dark in cities with urban contemporary stations in the late 80s, lighter elsewhere. Another map shaded by changes in violent crime over the same period. They don't line up in the way the moral story would want. Some high-exposure places improved. Some low-exposure places worsened. The picture forces you to abandon the simple, more rap, more crime story. Fourth, a scatter plot with counties as dots. X-axis, cumulative hip-hop exposure for teens in that county. Y-axis, changes in education or earnings for that cohort. The dots form a cloud with no strong slope. Statistically, that around 0 picture is what Fryer is talking about. What is the article really saying underneath the graphs? First, that clean natural experiments in culture are rare, But here we actually have one. Radio technology and programming policy gave us variation and exposure that isn't just kids who like rap. Second, that when you test the core fear, does aggressive music poison long-term outcomes, the answer in this data is no. Third, that our instinct to regulate expression when outcomes worsen is misdirected. School bans, censorship, moral lectures go after what's easiest to see. The deeper drivers, jobs, safety, family structure, remain untouched. So what does this mean for founders, operators, investors? Lesson 1. Incentives determine where you look for causes. If you're a politician, the incentive is to blame what's visible. Songs, shows, platforms. They're easy to regulate. If you're a serious builder or capital allocator, your incentive is different. You want the root causes, because only those offer compounding returns when you fix them. Fryer's work is a reminder. Superficial correlations are tempting and wrong. Lesson 2. Narratives can lag reality for decades. For 40 years, the narrative around hip-hop has been that it causes decay. Meanwhile, the data says its net effect on key outcomes is essentially neutral. If you're investing, that's a caution flag anytime you see a vice industry or a controversial category. The moral panic can be wildly mispriced relative to actual harm. Lesson 3. Systems evolve around underlying economics, not around noise. Hip-hop became a multi-billion-dollar market in music, fashion, advertising, and media because it spoke to real conditions. If hip-hop had never existed, Fryer argues, the trajectory of the hardest-hit communities would have been the same. Jobs, families, violence. That was driven by policy, markets, and opportunity, not by beats per minute. For us, that translates directly. You don't fix broken communities by editing playlists. You fix them by changing the cash flows and the constraints. Capital allocation at the societal level. The core question Fryer poses is deceptively simple. Did hip-hop help or hurt the people who heard it most? His answer is that, in terms of measurable outcomes, it mostly didn't move the needle. The communities were where they were because of economics, not because of the soundtrack. If we want gentler lyrics, as he puts it, we should solve the problems they describe. The music will follow. And the sentence I'd keep in my head is this. When we mistake the soundtrack for the script, we waste decades fighting the speakers, while the real forces compounding in the background go completely unchecked. Moving to next title, Arms sellers walk tightrope between investors. Trump. We absolutely feel the responsibility and urgency to deliver more and to deliver it faster. That line from RTX's CEO, Chris Callio, captures the tension at the heart of this Wall Street Journal piece. U.S. weapons makers are being pushed hard by President Trump and the Pentagon to behave like they're on a wartime footing, while public markets still expect them to behave like steady, cash-returning compounders. The article is about that tightrope, how you run capital allocation when your single biggest customer can threaten your dividends and buybacks with an executive order, yet your shareholders bought you for those exact dividends and buybacks. As value investors, this is where the real work is, understanding who ultimately controls the cash flows. The central actors here are the big four U.S. defense contractors, RTX, Lockheed Martin, Northrop Grumman, and L3 Harris. Think of them as founders of a sort, not of startups, but of the modern U.S. defense industrial base. They are builders of capacity, missiles, rocket parts, interceptors, jets, satellites. They are allocators of enormous and relatively predictable cash flows, and they are constrained by a single buyer, the U.S. government. For years, what worked was simple: grow slowly on the back of long procurement cycles. Maintain high returns on capital with oligopoly positions. Return a lot of free cash to investors via dividends and buybacks. The industry delivered. The S&P Aerospace and Defense Select Industry Index is up 56% over the past 12 months, versus 15% for the S&P 500. Lockheed ends the year with a record $194 billion order backlog, and enough cash to shore up its pension. RTX's annual profit just surged 41%. Defense has looked like a safe compounder. Geopolitical tailwind, fiscal tailwind, capital light versus backlog, plus high payout ratios. What quietly stopped working was the assumption that Washington would tolerate that capital allocation pattern forever, especially once real wars started eating into stockpiles. The inflection point is clear in the article. On the demand side, you have active conflicts, from Ukraine to the Middle East, burning through U.S. missile inventories. Defense Secretary Pete Hegseth says outright that the Pentagon needs an industrial base on a wartime footing to address new threats. Pentagon officials have spent months urging companies, expand now, don't wait for contracts to be fully baked. On the political side, you have Trump going public and personal. Early January, he issues an executive order that threatens to limit contractors' spending on CEO pay, dividends, and buybacks. He singles out RTX's Raytheon division by name, saying military leaders have complained about delayed deliveries and slow investment in new manufacturing capacity. He posts, either Raytheon steps up and starts investing in more upfront investment like plants and equipment, or they will no longer be doing business with Department of War. He deliberately uses Department of War, the alternative name the Pentagon has adopted. So the environment changes from, we like your steady cash returns, to, we're watching your capital spending choices, and we're willing to weaponize your payout policy if you don't move. How do the companies respond? Let's walk through each as a capital allocation case study. RTX first. Kallio acknowledges the pressure. RTX plans to devote more than $3 billion this year to capital expenditures, including investments in missile production. That's real money going into plants and equipment. At the same time, he defends a $3.6 billion annual dividend payout. He literally says, we recognize our shareholders rely on our dividends, and they've come to expect our dividends. What was expected? RTX could have chosen to protect the dividend and buybacks, run CapEx more slowly, and hide behind long lead times. What actually happens is a partial pivot. More CapEx, but an explicit commitment to keep the dividend sacred. The opportunity cost is obvious. Every incremental dollar into factories is a dollar not available for buybacks or near-term financial engineering. The hidden trade-off is political risk. If the company pushed CapEx too little, it risks future contract flow. If it sacrificed the dividend, it risks its valuation multiple. Lockheed Martin next. Lockheed responds in January with a clear spur-to-expansion decision. More than triple output of PAC. 3 interceptors, the missiles that fill Patriot air defense batteries. It also pledges to quadruple production of THAAD interceptors, high-end anti-missile systems. These are not cheap lines to ramp. They require tooling, supply chain expansion, workforce, and long-term commitments. Lockheed ends the year with that $194 billion backlog. It also has enough cash to shore up its pension, which it does. On the capital allocation call, CEO James Taiclet doesn't lay out a neat formula. Instead, he says they will continue to operate in a dynamic way, more dynamic than ever. That's code for, we're juggling more constraints than usual. Growth CapEx, pension obligations, dividends, and political optics. General Dynamics. It makes nuclear submarines and Gulfstream business jets. CEO Phoebe Novakovic is blunt, committed to the dividend. She doesn't talk details on buybacks, but she acknowledges they're not particularly popular right now. That says it all. What worked, steady repurchases, alongside rising dividends, is now reputationally risky in Washington. Northrop Grumman. They say they invested early to triple production of certain missile parts. They've also spent money up front to position for Trump's proposed Golden Dome anti-missile shield, the Navy's next-generation F/A-XXX fighter, and uncrewed combat jets. That's long-cycle CapEx with optionality attached. If those marquee programs hit, Northrop is in pole position. But the Pentagon hasn't yet rewarded those bets with actual orders from those programs. CEO Kathy Warden admits, as of January, we have not yet seen those opportunities progress toward contract, though they believe it will happen over the next 24 months. CFO John Green takes one concrete step. Pause stock buybacks after January to focus on the industrial base. That's a very clear capital allocation choice. Defend the balance sheet and capacity, sacrifice some EPS engineering and near-term shareholder yield. Then there's L3 Harris. They go furthest. L3 Harris plans to spin off its missile unit into a new public company, backed by a $1 billion Pentagon investment. The plan would give the U.S. government a minority stake after an IPO later this year. CEO Chris Kubasik explains the logic. There is no waiting for contracts or acquisition funding. The investment gives us the confidence to build today. This is state-backed equity as industrial policy. What was expected? Traditionally, Pentagon funding comes via contracts and cost-plus arrangements, not through equity stakes. What actually happens with this $1 billion injection is a hybrid. The contractor gets upfront capital and demand signaling. The government gets influence via a minority stake. Opportunity cost, L3 Harris gives up some control and a slice of future upside in that missile business. Hidden trade-off, it embeds political risk directly into the cap table, but it also de-risks the build-out and makes it much easier to justify aggressive capacity expansion. Now imagine the visuals on screen that anchor this story. First, a one-year performance chart showing RTX, Lockheed Martin, and Northrop Grumman versus the S&P 500. Defense stocks in bold colors, all up sharply, some near 50 to 60%, while the S&P 500 in a muted line is up about 15%. The viewer sees the outperformance that attracted capital in the first place. Second, a bar chart of the S&P Aerospace and Defense Select Industry Index, plus 56% over the past 12 months, versus plus 15% for the S&P. Short vertical bars, defense much taller. It's the picture of a sector that has already been re-rated. Third, a simple graphic showing Lockheed's order backlog, a bar at $194 billion, labeled Record Backlog. That single number tells you why these companies feel confident investing. Revenue visibility stretching out years. Fourth, a schematic of missile production. One bar showing current PAC, 3 output, another triple that height, labeled Lockheed Commitment. Next to it, a THAAD bar quadrupling. The creator is really saying, the capacity ramp the Pentagon is demanding is massive, not marginal. Fifth, a diagram of the L3 Harris missile spinoff. A box labeled L3 Harris Missile Co., new public company, with arrows from L3 Harris, majority owner, and Pentagon $1 billion equity stake. That visual makes clear that the government is becoming a direct financial partner, not just a customer. The reality check for us as investors is uncomfortable but necessary. Defense looks safe because the demand side is political. You don't get huge drops in military budgets without a major regime change. But the supply side is now political too. How you allocate capital is under direct presidential pressure. Trump's executive order explicitly threatens CEO pay, dividends, and buybacks. That's a shot right at the cash return thesis. We have to separate reputation from signal. Reputation, defense contractors as reliable dividend payers and buyback machines. Signal, CFOs pausing buybacks, CEOs talking about wartime footing, and the Pentagon taking equity stakes. The steady capital-light cash cow is being asked to become a heavier capex growth utility for a period. Perception lags reality in one key way. Many investors still treat defense like a bond proxy. Low risk, predictable payouts. But the article shows a sector mid-transition, capex rising, political constraints tightening, payout policy becoming a bargaining chip. 3 lessons for long-term owners. First, incentives shape capital allocation far more than spreadsheets. The incentive of the Pentagon under Trump is to get more missiles, faster, with less tolerance for financial engineering. The incentive of management teams is to preserve access to future contracts. So when push comes to shove, they will sacrifice buybacks before they sacrifice production. The article already shows that happening at Northrop and implicitly at General Dynamics. If your thesis is purely based on shareholder yield, you are on the wrong side of that incentive stack. Second, scale becomes a double-edged sword when your only customer is also your regulator. RTX, Lockheed, Northrop, L3 Harris, they're indispensable. That scale gives them bargaining power, but it also makes them uniquely exposed when the White House wants to make an example. You can hear it in Trump's Raytheon call-out. Smaller suppliers fly under the radar. The giants are on the front page. For investors, that means higher political beta even in a defensive sector. Third, success plants the seeds of political backlash. Years of high payouts, slow capacity expansion, and strong stock performance are exactly what drew the executive order. Defense stocks crushed the S&P 500. Order books hit records. Dividends and buybacks flowed. At some point, it looks, especially in a populist frame, like shareholders are capturing more of the war dividend than the war fighters. The order is Washington's way of rebalancing. So what's the core question this journal article is really asking? It's not, are defense stocks good or bad? It's, can these companies simultaneously satisfy a wartime Pentagon and yield hungry investors without breaking one of those promises? My answer is that, over the next few years, the true north for management will be the Pentagon, not Wall Street. They will keep the dividends as far as they can, but buybacks and EPS games are already on the chopping block in favor of capacity and political alignment. The compounding will increasingly come from real growth, missiles built, backlogs converted, not from financial engineering. And the one sentence I'd want you to remember is this: when your only real customer threatens your dividend, the moat isn't the payout. It's your ability to build so much real capability that both Washington and your shareholders have no choice but to. Moving to next title, Food Stamp Overhaul Challenges Grocers. It wasn't until this year that he needed to figure out what candy really is. That line in the Wall Street Journal is about a fifth-generation grocer in Terre Haute, Indiana, but it might as well be about how policy actually hits the ground. It's one thing to announce a nutrition crusade from Washington. It's another thing entirely to decide at a scanner whether a yogurt-covered pretzel is candy or food, whether kettle corn is allowed, depending on whether it's pre-popped. This moment matters because it's part of a larger repeating pattern. Governments try to engineer behavior at the consumer level, but the operational and capital costs get dumped onto the operators in the middle. Small grocers, regional chains, the people actually running inventory systems and checkout lines. And as investors, we have to be honest about where the friction and risk really sit. The central figures here are not founders of a tech company. They're a set of operators and one political architect. On the policy side, you have U.S. Agriculture Secretary Brooke Rollins and the Trump administration's Make America Healthy Again movement. She's the architect. She's trying to restore the Supplemental Nutrition Assistance Program, SNAP, to what she calls its true purpose of nutrition. On her first day in office, she sends a letter to governors urging them to introduce changes to nutrition programs. The stated goal: empower states, protect children from highly processed foods, move toward the president's promise to make America healthy again. On the operator side, you have people like Bob Basler of Basler's Market in Indiana, a fifth-generation grocer. You have Mark Griffin at B&R Stores, Joe Lackey at the Indiana Grocery and Convenience Store Association, Mike Wilson at Cubby's. They are the builders and allocators in this story, because they're the ones who have to translate broad slogans into barcodes, planograms, and labor schedules. For a long time, what worked in SNAP was simple. The program dates back to the food stamp era, became permanent in 1964, and historically the eligibility line was narrow. You couldn't buy alcohol, tobacco, supplements, hot foods, or live animals. Beyond that, SNAP dollars worked like money for groceries. In fiscal 2024, SNAP served 41.7 million participants a month. Federal spending was $99.8 billion. Average monthly benefits were $187.20 per participant. The federal government funded it, the states administered it, and retailers executed at scale. The rules on what you could buy were remarkably stable. Product eligibility hadn't changed. The program's focus was access, not micromanaging the basket. What quietly stopped working for the politicians was the optics. Soda and junk food became symbols of waste and poor diet. Big food and beverage companies, PepsiCo, Mondelez, others, were already facing increasing scrutiny over American diets, and shoppers were tightening grocery spending. It was an easy narrative move. If we want better health outcomes, we should stop subsidizing soda and candy with federal benefits. So here's the inflection point. Beginning last year, the Trump administration pushes to strip soda and junk food from SNAP by encouraging states to restrict what recipients can buy. 18 states adopt new restrictions. More could follow. Rollins frames it as restoring nutrition, empowering states, protecting children. On paper, it sounds straightforward. No more taxpayer-funded candy bars and sodas. On the ground, it looks very different. Inside Basler's Market in Terre Haute, fresh cinnamon buns from the bakery are still eligible for SNAP, according to the Indiana Family and Social Services Administration. Mini donuts in a Valentine's Day display are eligible. Gum, fruit strips, candy bars, those are out. Basler calls it a challenge, but says if it helps people eat healthier, he's for it. Across the U.S., retail employees are sifting through state-issued flowcharts, scanning barcodes, checking ingredient lists on thousands of SKUs. They have to catalog everything correctly in back-end systems, so the point-of-sale terminals know what's eligible. And the devil is in the details. Small differences matter now. Is kettle corn pre-popped? That can determine whether it's eligible. Are pretzels covered in yogurt? That can push them from food into candy. The line between allowed and banned runs through packaging formats and coding ingredients. Critics point out a deeper issue. Limiting grocery options this way ignores the primary causes of poor diets: low incomes, high food prices, limited access to healthy food. Studies, they say, show little difference between what SNAP recipients buy and what non-SNAP households buy. The underlying behavior is similar. The program is not uniquely distorting diets. The USDA responds by saying federal efforts, including new dietary guidelines, will help educate consumers on healthy choices. But guidance on implementation has been patchy. Retail executives and industry groups say USDA and many state agencies have given insufficient guidance on how to implement the new restrictions. That has created confusion, especially in 5 early mover states: Indiana, Iowa, Nebraska, Utah, and West Virginia, where limits took effect on January 1st. USDA says it has worked with states to educate retailers and recipients. State officials in Indiana, Iowa, and West Virginia say they've been communicating about product eligibility and sometimes offering training. A Nebraska official says no supermarkets have complained to its Health and Human Services Department. Yet the industry's experience tells another story. Indiana's policy is the most restrictive of the early states, with nearly 74,000 items ineligible for SNAP purchase, according to FMI, a trade group for food retailers and manufacturers. 74,000 SKUs effectively flagged as no for one slice of your customer base. Look at what that means in practice. FMI points to inconsistencies. A SNAP customer in Idaho could buy a chocolate-covered cookie bar because it contains flour, but not a plain milk chocolate bar because it doesn't. In Utah, that same customer could buy both products. In Arkansas, they could buy neither. So your eligibility depends not just on what you're eating, but where you're standing. SNAP recipients can use their benefits in any state, not just their home state. That creates migration risk. Joe Lackey, representing Indiana grocers, points out that his state is bordered on all sides by states that haven't adopted new restrictions. Grocers in Indiana's border areas are likely to lose business as SNAP customers cross state lines to shop where the rules are looser. He says bluntly, "We are not an island state. Our border areas are really going to suffer. If you're a SNAP user with limited cash and you want soda or candy, you'll drive across the bridge if you can." That shifts revenue from one state's retailers to another's. The same policy that looks tough on junk food at the state house can quietly export sales and margin to your neighbors. At the store level, the capital allocation is very tangible: time, systems, and training. Mark Griffin, CEO of B&R Stores, talks about dealing with lines at checkout when clerks have to tell longtime customers they can no longer use food stamps to buy soda or candy. His chain runs 33 stores across Nebraska, Iowa, and Missouri. He says they did a massive effort to educate store staff about what was happening, to prepare them for confrontations. It takes more time to take items off tickets, reverse line items, and restock banned goods. That is labor cost and friction embedded right at the point of sale. Mike Wilson, COO at Cubby's, worries that an employee will accidentally sell a banned item to a SNAP customer, jeopardizing that store's eligibility for the program. Cubby's has about 40 stores across Nebraska, Iowa, and South Dakota. The risk isn't just a misscanned candy bar, it's losing access to a $99.8 billion federal revenue stream. That's existential risk for a small operator. And don't forget the suppliers. Soda and snack companies, PepsiCo, Mondelez, and others are already facing a pincer: more health-conscious consumers, more government scrutiny. Now, in at least 18 states, parts of their catalog are structurally harder to buy with SNAP. It's not that SNAP is the majority of their volume, but when you combine this with other trends, sugar taxes, labeling rules, shifting preferences, it adds up to a secular headwind on certain SKUs. Let's bring in the visuals so you can see what the article is talking about. On screen, imagine a map of the United States. A set of states shaded to show SNAP purchase restrictions currently in place. Another set shaded differently for restrictions planned. 18 states lit up so far: Indiana, Iowa, Nebraska, Utah, West Virginia highlighted because their limits took effect January 1st. You can see that Indiana is surrounded by states without shading, neighbors without restrictions. The map is really saying this is not a national, uniform regime. It's a patchwork, and that patchwork creates competitive distortion between border retailers. Next, picture a small table on the map showing product examples by state: Coca-Cola Original Taste, Gatorade Lemon Lime, M&M's Milk Chocolate, a tub of ice cream, each either tagged eligible for SNAP or restricted from SNAP in different states. You can literally see that Coca-Cola might be banned in one state and allowed in another. M&Ms may be treated as candy in one state, ice cream is allowed elsewhere. Then there's a flowchart on screen that answers a specific question. Can you use Snap to purchase a Lipton sparkling lemonade iced tea in Utah? It walks through 3 yes or no questions. Is it carbonated? Is it made from milk, a milk substitute, or more than half real fruit or vegetable juice? Is it sweetened with natural or artificial flavors? Follow the arrows. Not carbonated, made from these products, not sweetened. This particular beverage, as defined, ends up eligible or not depending on where it lands in that logic. The point of that visual isn't the tea. It's the complexity. Clerks and systems are expected to run that decision tree on thousands of items and keep it updated as states tweak definitions. Finally, picture a chart titled Where Restrictions on SNAP Purchases Have Been Put in Place or Are Planned, and next to it, another chart showing which products count as candy or soda in each state. The creator is saying, this is not a simple soda out vegetables in rule. It's an evolving regulatory maze. Now, the reality check. First, uncomfortable truth. This is behavioral engineering executed through operational friction. The administration wants to change what low-income households buy by making some items unavailable to them with SNAP. But the implementation burden falls on grocers, not on the policymakers. It's Baszler and Griffin and Wilson who have to invest in systems, training, and conflict management. That's a transfer of cost and risk from the state to the store. Second, the policy may not meaningfully change diets in the way its advocates imagine. Critics point out that SNAP and non-SNAP households buy similar baskets, that diet quality is driven by income, prices, and access. You can ban gum and soda on SNAP, but if the underlying environment doesn't change, people will either spend cash on those items or switch to allowed substitutes that are not necessarily healthier. Fresh cinnamon buns and mini donuts are still eligible in Indiana. The distinction between good and bad food here is often symbolic. Third, the political upside is front-loaded. The business downside is compounding. Politically, Rollins and the administration get to say they are protecting children from highly processed foods and restoring nutrition to SNAP. That's a clear soundbite. For grocers and suppliers, the costs accumulate quietly. Extra minutes per transaction, more customer confrontations, SKU management overhead, cross-border leakage of SNAP spending. Over 5 or 10 years, those frictions add up to real erosion of convenience and margin. The federal government is incentivized to show action on obesity and diet. States are incentivized to demonstrate tough standards. The natural place to dump complexity is on retailers. They have no political constituency, but they do have the systems. As investors in grocery, we have to recognize that point-of-sale rules are not just compliance. They are capital allocation, because they consume time, training, and tech budget. Lesson 2. When scale becomes a disadvantage, nimbleness can be a moat. Big chains can build eligibility engines, product databases, and training programs to handle these rules. Small, fifth-generation markets like Baszler's struggle more. The operational leverage works against them. At the same time, smaller stores near state borders might adapt by deliberately targeting non-SNAP customers or specializing in allowed items. The question is, who can absorb regulatory change as a routine operating cost rather than a one-off crisis? Lesson 3. Success plants the seeds of second-order risk. SNAP is a $99 billion federal program serving over 41 million people. For decades, retailers came to treat that flow as stable, like a regulated revenue stream. The more your model depends on it, the more vulnerable you are when the rules governing what can be bought start to fragment. The same program that once felt like a cushion now becomes a channel for behavioral policy experiments. The core question the Wall Street Journal is raising is this: can you overhaul what 40+ million people buy with federal benefits through product-by-product restrictions without doing lasting damage to the very retail system that feeds them? My answer is that you can push at the edges, but the real risk is you burn operational and relational capital. Check out trust, staff morale, cross-border competitiveness, while leaving the deeper drivers of diet mostly untouched. And the sentence I'd want you to remember is this: anytime a government program turns a grocer's barcode scanner into a moral referee, you should assume the true cost won't show up in the nutrition data. It will show up, slowly and quietly, Moving to next title, Oracle seeks up to $500 billion for AI infrastructure. Oracle wants to raise between $45 and $50 billion this year to fund its artificial intelligence infrastructure build-out. That single decision, in one article from the Wall Street Journal, tells you almost everything about where we are in the AI cycle. The narratives are still huge. The numbers are now catching up, and when the numbers arrive, you finally see what kind of business you actually own. This isn't just about a software company chasing a hot trend. It's about a mature tech giant turning itself into an AI utility, building the equivalent of roads, power lines, and data centers for a very small number of extremely demanding customers. That shift is all about founders, operators, incentives, capital allocation, and what compounding looks like when the CapEx bill hits. Let's start with who matters here. The central figures are Oracle's leadership and the AI clients they've decided to serve. Oracle is described in the piece as a cloud services giant that is seeking fresh capital to satisfy growing demand from clients. The customers are a who's who of AI and internet scale: NVIDIA, Meta Platforms, TikTok, OpenAI, Elon Musk's xAI, and AMD. Oracle's leaders are the builders. They are choosing to build cloud infrastructure at a scale that requires up to $50 billion of additional capital in a single year. Not over a decade. In 1 year, they're not just adding a few racks. They're effectively expanding a global grid for AI workloads. They are also the allocators. The company expects to raise the money through a combination of debt and equity. Roughly half of the total is supposed to come through equity-linked and common equity issuances. The other half is expected to come from a single, one-time issuance of investment-grade senior unsecured bonds early in the year. That mixed dilution plus leverage, one big bond deal, is pure capital allocation work. Someone sat in a room and decided that this is the optimal way to fund the AI build-out. And they are the constraint. Because at the same time, investors are described as having soured on AI stocks in recent months. They are worried that companies might be overspending on AI, potentially creating a market bubble that is waiting to burst. Oracle's own shares had closed the prior Friday at their lowest level since May 2025. On the day of this announcement, the shares seesawed. They initially declined more than 2%, then reversed to log gains above 6%, and ultimately ended the day down 2.8%. That's the market telling you it hasn't decided yet whether this is genius or overreach. What worked for a while is important to understand. Oracle emerged as an AI darling last year after securing hundreds of billions of dollars of AI-related business. The standout is a contract with OpenAI to purchase $300 billion of computing power over roughly 5 years. That's about $60 billion a year in compute commitments from a single customer. Those are power plant numbers. When Oracle announced strong AI bookings, what it calls remaining performance obligations, contracted sales that have yet to be recognized as revenue, the stock reacted like a rocket. It closed 36% higher in a single day in September. That was the largest one-day gain since December 1992. Those bookings, those contracts, those obligations, that was the story the market loved. For a while, the model looked perfect. You sign giant AI deals with blue-chip customers. You show hundreds of billions in AI business. You point to $300 billion in compute commitments from OpenAI alone. You watch your stock gap up. The business feels asset-light because revenue is in the future, and CapEx is still an abstraction. What quietly stopped working is the illusion that this AI growth comes without paying the full upfront price. The article makes it clear, to meet demand it has already contracted. Oracle now needs to build capacity in its cloud infrastructure business. That's what the $45 to $50 billion fundraise is for. It's not optional growth CapEx. It's the price of delivering on promises already made. This is the inflection point. Oracle is no longer just announcing huge AI bookings. It is standing up and saying we will now take on as much as $50 billion of new capital, half equity, half debt, to build the infrastructure required to serve NVIDIA, Meta, TikTok, OpenAI, xAI, and AMD at the scale we've promised. Look at the contrast. Last year, huge AI contracts, a 36% one-day stock pop, the status of AI darling, and very little concrete discussion about how much capital would be needed to actually deliver the compute. Now, investor skepticism about AI overspending, talk of a potential bubble, shares at a multi-month low, and a massive capital-raising plan that exposes how capital-intensive this strategy really is. Copying the past now fails because the past was the easy part. Sign the deals, tell the story, enjoy the re-rating. The next phase is about execution under the weight of real capital. Evolution is unavoidable. Oracle is moving from AI narrative to AI infrastructure, and infrastructure has different economics. It's heavier, it's slower, it tests discipline. Let's do the decision autopsy on the capital allocation here. Decision 1. Secure hundreds of billions of dollars of AI-related business. What was expected? The expectation, explicit in the AI darling label, is that securing large, long-dated AI contracts with big customers would drive explosive, high-margin growth. The OpenAI contract to purchase $300 billion of compute over roughly 5 years looks like a long-term, visible revenue stream. Remaining performance obligations are presented as strong, contracted bookings, like a backlog you just need to work. Oracle plans to raise roughly half of the $45 to $50 billion through equity-linked and common equity issuances. That's future dilution. Existing shareholders will own a smaller piece of a larger pie. The other half is expected to be funded by a single issuance of investment-grade senior unsecured bonds early in the year. That adds leverage and interest obligations that must be serviced before equity sees any of the AI cash. The hidden trade-off is this. Oracle is trading balance sheet safety and per-share ownership for the ability to serve a concentrated set of AI hyperscalers at massive scale. The bet is that the earnings on that infrastructure will more than compensate for the dilution and the debt. But that is not guaranteed. Decision 3. Concentrate a large chunk of future revenue on a few customers. The article states clearly that Oracle's capital-intensive business model concentrates a large portion of future revenue on a small number of tech giants. What was expected? In the AI hype phase, investors tend to view logos as validation. NVIDIA, Meta, TikTok, OpenAI, xAI, AMD, these names on your customer list make you look indispensable. The expectation is that deep relationships with these giants create stickiness and long-term cash flows. What is actually happening? Concentration cuts both ways. If AI spending remains strong and these customers continue to ramp, Oracle will enjoy massive throughput on its new infrastructure. If AI spending slows, if budgets get cut, if one of these players changes strategy or builds more in-house capacity, Oracle's utilization falls, and return on that $50 billion of capital drops sharply. The opportunity cost is the alternative, a more diversified, slower but steadier revenue base that doesn't require betting half the balance sheet on a small set of partners. Now, because you'll have text on screen in your podcast, let's talk about what you actually show, using only what's in the article. On screen, when you introduce Oracle, I'd have the headline from the Wall Street Journal. Oracle seeks up to $50 billion for AI infrastructure. Under that, the key line. Oracle said it plans to raise between $45 billion and $50 billion this year to fund its artificial intelligence infrastructure build-out. Next line. The cloud services giant said it expects to raise the money through a combination of debt and equity. That's the thesis in 3 lines. When you discuss the customer side, show a simple list extracted directly from the article. Clients, NVIDIA, Meta Platforms, TikTok, OpenAI, Elon Musk's xAI, advanced micro devices. Underneath, the phrase, hundreds of billions of dollars of AI-related business. OpenAI contract to purchase $300 billion in computing power over roughly 5 years. You don't need any invented chart. The text itself is the visual. When you talk about the fundraising mix, put 2 short lines side by side on screen. Tilde 50% via equity-linked and common equity issuances. Tilde 50% via a single issuance of investment-grade senior unsecured bonds early this year. Then a caption, capital to build capacity for contracted AI demand. That's exactly what the article says. When you cover sentiment, show the sentences about the stock. Oracle shares seesawed in trading, initially declining over 2% and then reversing course to log gains above 6% later in the session. They ended Monday down 2.8%. The company's shares closed Friday at their lowest level since May 2025. And then the earlier line, Oracle stock closed 36% higher in a single day in September, the largest one-day gain since December 1990. 2. The contrast between those 2 lines is the story. Euphoria versus skepticism. Finally, for remaining performance obligations, show the explicit phrase the article uses. Strong bookings, known as remaining performance obligations, contracted sales that have yet to be recognized as revenue. That line is key because it shows how much of the narrative was built on contracts rather than cash. Now let's do the reality check investors don't like to hear. First, uncomfortable truth. This is not a pure software story anymore. When you need $45 to $50 billion of fresh capital to fund a build-out, you are in the infrastructure business. You are building something that looks and behaves like a capital good. That doesn't mean it's a bad business. It means your returns are going to depend on utilization, pricing, and cost of capital, not just on how many AI logos you can list on a slide. Second, the article hints at bubble dynamics without using the word loudly. Investors are described as worrying that AI spending might be overshooting, potentially creating a bubble that is waiting to burst. Oracle itself is an example of that tension. A 36% one-day gain on bookings, then a slide to the lowest price since May 2005, and now a massive fundraise that forces people to ask, what if we're early? What if the payback is longer? What if demand normalizes? Third, concentration risk is not something you can diversify away quickly. When a large chunk of your future revenue is tied to a few AI leaders, you are essentially in a partnership with them, where they hold much of the optionality. They can rethink their spending, build more infrastructure themselves, or pressure pricing. You, as the provider, have already spent the money. The compounding equation becomes, can we earn enough on this heavy base of assets before the cycle turns or the bargaining power shifts? So what are the lessons for long-term business quality investors? Lesson 1. Incentives drive whether AI deals create value or just headlines. Oracle's incentive is to sign large, forward-looking AI contracts and then prove to the market that it is indispensable to the AI ecosystem. Its customers' incentive is to secure massive compute capacity and flexibility at the best possible term. It's this. Can Oracle turn huge, concentrated AI contracts, like a $300 billion compute deal with OpenAI, into durable, high-return cash flows after paying the full $50 billion cost of building the infrastructure? Or is it sliding into a capital-intensive role where the equity gets utility-like returns with tech stock volatility? My conviction is that the answer depends less on how big the next AI headline is and more on whether Oracle can say no to uneconomic growth matching every new dollar of capacity to real, defensible, high-margin demand, instead of to the need to look like the biggest player in the room. And the sentence I'd want you to remember for years is this. In AI infrastructure, the real compounders won't be the companies that announce the largest contracts, but the ones that keep their balance sheets small enough that every incremental dollar of capex moving to next title, stocks rise as commodities and crypto face volatility. Silver futures crashed 31% on Friday, while the Dow Jones Industrial Average rose more than 500 points on Monday. That's the tension in this Wall Street Journal piece. Stocks are grinding toward records, while commodities and crypto are getting whipped around in some of the wildest trading in decades. As an investor, I read this not as random noise, but as a live stress test of positioning, leverage, and how fragile certain trades really are when the macro narrative shifts even slightly. This isn't about predicting tomorrow's print. It's about recognizing a recurring pattern. Risk appetites move in waves, leverage piles up in the same places, and when the regime shifts, on inflation expectations, on rates, on politics, the marginal buyer disappears fastest in the most levered corners. Let's identify the key actors here. On the surface, you have indexes. The Dow up 1.1%, the S&P 500 up 0.5%, the Nasdaq Composite up 0.6%. Behind that, you have sector characters, Apple and Caterpillar driving the Dow. Industrials broadly outperforming on the back of a strong manufacturing reading. Semis like SanDisk, Western Digital, Micron and Intel bouncing at least 5% after a sell-off late last week. On the policy side, there are two names anchoring sentiment, Donald Trump and Kevin Warsh. Trump's tariffs and diplomatic signals shape expectations on growth, inflation, and trade flows. Warsh, floated as the next Federal Reserve chairman, is seen by investors as an inflation hawk, someone who implies a stronger dollar and more stable monetary policy. That combination, in a market stuffed with leveraged bets on precious metals and crypto, is enough to flip the sign on a lot of trades. The builders here are the participants who constructed these positions, individual investors who poured nearly $1 billion into silver-linked ETFs, from mid-December to mid-January, the heaviest 30-day buying period in history for those products. Fund sponsors who created leveraged vehicles like the ProShares Ultra Silver ETF, explicitly designed to double the daily returns of silver, up or down, using borrowed money and derivatives. Crypto-focused investment firms like Hashdex and exchanges such as Coinbase, whose equity became proxy bets on digital assets. These participants were building a particular kind of structure, a stack of trades all pointing in the same direction: higher metals, higher Bitcoin, looser policy, weaker dollar. For a while, what worked was simple. Gold had a historic rally. It traded above $5,000 a troy ounce for the first time ever just a week before this article. Silver futures surged past a 45-year-old record high in October, then more than doubled from there. Platinum and palladium both rallied. Copper, although more tied to real economy demand, rode the same wave, supported by long-term narratives around EVs, renewable energy, data centers, and infrastructure. Crypto, too, had been a beneficiary of earlier risk-on phases. Even with an 11% drop year-to-date at the time of this piece and a 7% decline since Friday's close, Bitcoin's prior cycles conditioned people to buy dips. Coinbase shares became a high beta play on that behavior. Those trends were reinforced by genuine structural stories. For metals, fears about dollar debasement, central banks, including China, buying gold, and investors looking for inflation hedges. For copper, S&P Global estimating demand up 50% by 2040, with a projected 25% supply shortfall as mining output dwindles. For gold, a backdrop of multiplying geopolitical flashpoints, making it the haven of choice, with prices at record highs in both real and nominal terms. On screen, you can picture this build-up visually with the article's framing. A headline like, "Swings in Gold and Silver Turn Wild," an AP photo of traders or gold bars, and text calling out gold over 5,000 and silver breaking ancient records. That's the mania phase. What quietly stopped working was the assumption that this could continue without a policy or positioning shock. The rally began to sputter late Thursday when news outlets started reporting that Trump was planning to nominate Kevin Warsh as the next Fed chair. Warsh is viewed as an inflation hawk. That implies a stronger dollar and more stable monetary policy. The dollar had its best day since May. In a market where precious metals had already run far beyond fundamentals, that was enough to trigger a cascade. Silver futures crashed 31% in a single day on Friday. Gold futures dropped 11%. Platinum and palladium each fell more than 15%. Copper shed 4.5%. This was the largest daily loss for gold and silver in more than 4 decades. On Monday, the decline continued. Gold settled at $4,622.50 a troy ounce, down 1.9% on the day, but still up 6.9% for the year. Silver fell another 1.9% to $76.78 a troy ounce. The leveraged silver ETF did exactly what it was designed to do. It crashed 60%, roughly double silver futures' 31% loss. Before that plunge, it had more than $5 billion in assets. That's the debt-fueled component of this story. Leverage magnifying both the rise and the fall. Meanwhile, Bitcoin had its own drama. Over the weekend, Bitcoin sold off sharply, hammered by a broad investor shift away from technology stocks and other risky assets. It hit its lowest intraday level since last April, back when Trump's Liberation Day tariffs were shaking markets. By Monday, Bitcoin finished up 1.2% on the day, but it was still down 11% year-to-date and down 7% since Friday's close. The equity proxies felt it. Coinbase shares finished down 3.5%, marking the 10th consecutive daily decline, its longest losing streak since listing in 2200. Robinhood, which had made significant pushes into crypto, fell 9.6%. Strategy, the Bitcoin accumulator formerly known as MicroStrategy, sank 6.7% and closed at its lowest price in more than a year. So you had, simultaneously, equity indexes rising, and commodities and crypto getting battered. That's the environment the article is capturing. Now let's look at what changed on the stock and rate side. The Dow rose more than 500 points, up 1.1% to 49,407.66, less than 200 points from its record. The S&P 500 gained 0.5% and finished just a hair below its record high. The Nasdaq Composite added 0.6%. What drove that? A strong manufacturing reading from the Institute for Supply Management, suggesting U.S. factory activity was growing at its fastest pace since August 2022. That's a real economy signal. It pushed expectations toward stronger growth. Treasury yields inched up. The 10-year yield critical for borrowing costs settled at 4.276%, up from 4.24% on Friday. Not a massive move, but directionally consistent with better growth expectations and a more hawkish perceived Fed chair. Industrials outperformed. Caterpillar gained 5.1%. GE Vernova advanced 3.9%. Semis like SanDisk, Western Digital, Micron, and Intel all finished up at least 5%, making them among the S&P's top gainers. Apple, having reported earnings the prior week, climbed 4% and buoyed all three major indexes. Oil prices retreated. After Trump said on Saturday that he believes Iran is negotiating seriously with the U.S., benchmark Brent crude futures fell 4.4% to $66.30 a barrel. The geopolitical risk premium came off. Trump also announced that the U.S. agreed to reduce tariffs on India to 18% from 25%, with India in turn agreeing to stop buying Russian oil. That's a specific example of tariffs and energy flows interacting. Meanwhile, the January jobs report was delayed due to a partial government shutdown, adding another layer of uncertainty. On screen, the article includes a simple chart, an intraday line graph showing the S&P 500, Dow, and Nasdaq movements in 5-minute intervals from 10 a.m. to 4 p.m. The y-axis runs from negative 0.5% to positive 1.25%. You see the lines starting near zero, wiggling, and ending in positive territory. Stocks grinding higher through the session. That visual is measuring index performance over the day. It matters because it contrasts the steady equity climb with the violent moves in metals and crypto. There's also an auction results table. You'd see a small box listing Monday's Treasury bill auctions. 13-week bills, about $254 billion in applications, $93 billion accepted, with $1.8 billion in non-competitive bids and $100 million in foreign non-competitive bids. Auction price 99.09, implying a 3.6% discount rate and a 3.684% investment yield. 26-week bills, about $240 billion in applications, $80.4 billion accepted, $1.76 billion non-competitive, $80 million foreign non-competitive, with an auction price of 98.217. 917, a 3.525% discount rate, and 3.639% yield. That table is measuring the demand and yields for short-term government paper. It matters because it tells you where safe cash is being parked while other assets are swinging wildly. Another visual on the page is a long-term chart of average daily options, volumes from 1975 to 2025, with volumes climbing towards 60 million contracts. It's tied to the piece on SIBO exploring a relaunch of all-or-nothing binary contracts, similar to prediction markets. In the context of the metals and crypto story, it's a reminder that derivatives activity has exploded, making it easier than ever to take levered views that can then unwind violently. Let's do the capital allocation autopsy in this environment. Decision 1. Individual investors pouring nearly $1 billion into silver-linked ETFs from mid-December to mid-January, especially into leveraged products that double daily moves. What was expected? People expected to ride the momentum in metals, anchored on narratives of inflation, dollar debasement, central bank buying, and hard asset scarcity. A leveraged ETF promising double daily silver returns looks like a way to maximize that upside quickly. What actually happened? The leveraged ETF crashed 60% in one day, double silver futures 31% drop. That vehicle did exactly what it promised on the label. But from the investor's perspective, the path mattered. The heaviest 30-day buying period in history lined up almost perfectly with the top. The opportunity cost is brutal. Capital that could have been allocated to productive businesses with real cash flows was instead placed into a trade that was structurally fragile, reliant on continued inflows and supportive macro narratives. The hidden trade-off: you weren't just betting on metals, you were betting on no policy shift that would strengthen the dollar and on no positioning unwind. Most failures in this kind of product come from success carried too far. Too much leverage, too many late entrants, too little margin for error. Decision 2. using crypto-linked equities as long-term holdings rather than as high-beta trading instruments. What was expected? Holders of Coinbase, Strategy, and Robinhood stock often frame them as platforms at the heart of a new financial paradigm, not just trading chips. The expectation is that they will benefit from secular adoption of crypto assets, not just from cyclical booms. What actually happened in this window? 10 consecutive down days for Coinbase, a 3.5% drop on the day, taking it to its longest losing streak since IPO. Strategy down 6.7%, at its lowest in more than a year. Robinhood down 9.6%. These moves show that in stress, the market still treats these names as high-beta derivatives of Bitcoin. The opportunity cost of owning them as core positions is elevated volatility and drawdowns tied to factors, like weekend selling in Bitcoin, that have nothing to do with day-to-day business execution. The hidden trade-off: by owning the wrapper instead of the underlying, you concentrate idiosyncratic risks, regulatory, operational, governance, on top of asset class volatility. Decision 3. Policymakers signaling around rates, trade, and sanctions. What was expected? In the run-up to the metals peak, markets were pricing in a world of loose policy for longer, persistent inflation risk and a weaker dollar. That's part of what juiced the move above 5,000 in gold and past records in silver. What actually happened? The mere report that Kevin Warsh, a perceived hawk, might become Fed chair, along with Trump's messaging on Iran negotiating seriously and tariffs being cut for India in exchange for stopping Russian oil purchases, nudged expectations toward tighter conditions, a stronger dollar, and shifting commodity flows. The magnitude of the market reaction reveals how much positioning had been built on the opposite assumptions. The opportunity cost: had investors priced in a range of policy outcomes instead of extrapolating the current regime, the shock would have been smaller. The hidden trade-off is that simple stories: gold to the moon, Bitcoin as the new gold, crowd out scenario-based thinking. Now, the reality check. First, uncomfortable truth: the stronger the narrative, the more likely it is that investors over-allocate and underprice risk. Gold above 5,000, silver breaking decades-old records, copper as the new oil for electrification. These all have elements of truth, but when you layer in leverage, options, and ETF flows, the price can move far away from even generous fundamentals. This article shows the snapback, double-digit daily losses in metals, while the underlying macro picture shifts only modestly. Second, index strength can hide a lot of pain at the edges. The Dow and S&P flirting with records makes the environment feel benign. But under the surface, leveraged silver products are losing 60% in a day. Crypto-linked equities are on 10-day losing streaks, and individual investors are getting margin called. If you only look at the index chart, you miss where the actual capital destruction is happening. Third, liquidity and leverage turn time into an enemy, not a friend, for traders. The same daily rebalancing that makes leveraged ETFs track their target on the upside accelerates losses when volatility spikes. The same intraday liquidity that lets you trade Bitcoin around the clock also means you can gap lower over a weekend while equity markets are closed. Time isn't compounding in your favor in these structures, it's compounding slippage and path risk. So, what should a long-term business quality investor take away from this? Lesson 1. Respect the difference between a trade and an investment. A portfolio of productive businesses, industrial firms benefiting from a real manufacturing uptick, quality tech like Apple, even miners with strong balance sheets and low-cost assets, participates in cycles but is anchored in cash flows. A leveraged silver ETF designed to double daily moves is not that. Treating them the same is category error. Lesson 2. Most blowups come from success, not failure. The metals crash was enabled by the prior rally. $1 billion in ETF inflows, record-breaking prices. Coinbase's 10-day slide reflects the earlier exuberance that pushed it up as a pure proxy. Strategy's decline is rooted in its own aggressive Bitcoin accumulation strategy. The seeds of the drawdown are planted during the run-up. Lesson 3. Macro narratives are powerful, but they aren't a business model. Fears about dollar debasement, central bank buying, EV copper demand, crypto as digital gold, these are all inputs. But when you're allocating capital for compounding, the output you want is resilient free cash flow generation across cycles. This article makes clear that you can have the narrative right and still be wiped out if the vehicle you choose is levered, path-dependent, or structurally fragile. The core question this journal piece is posing is simple. In a market where stocks can grind higher while metals and crypto are getting violently repriced, where exactly do you want your long-term capital to live? On the stable backbone of businesses adjusting to higher rates and changing trade patterns? Or on the sharp edge of instruments that promise double the daily move in whatever happens to be hot? My answer is that you respect the volatility as a signal of where not to overconcentrate and use it instead as a reminder to anchor your compounding in businesses and assets that don't need perfect narratives to survive. And the sentence I'd want you to remember is this: anytime you see gold at records, silver doubling, and Bitcoin swinging, while the indexes quietly make new highs, assume the real opportunity isn't in chasing the swing, but in steadily owning the companies that will still be there when today's leveraged trades are long forgotten. Now towards last article, shrinking Fed easier said than done. Shrinking the Federal Reserve's balance sheet is easier said than done. That's the core idea of this piece from the Wall Street Journal. And it matters because the size and shape of the Fed's balance sheet is the invisible architecture behind every valuation you and I care about. Equity multiples, cap rates, credit spreads, the whole thing. When the Fed says we're going to shrink, it sounds like a clean, technocratic exercise. In reality, it's a political, operational, and market structure problem that resists simple solutions. I see this as one more round in a repeating cycle. Central banks expand aggressively during crises, markets normalize around that new floor, and then everyone realizes that going back is not only hard, it's potentially destabilizing. We saw it after the global financial crisis, we saw it after the pandemic, and this article is about that same movie, played again, under different characters, with higher stakes. Let's talk about the central figures, because behind every balance sheet line, there are people making decisions. First, you have the Fed's leadership, the chair, the governors, the regional bank presidents. They are the builders of this balance sheet. They chose to buy trillions in treasuries and mortgage-backed securities. They chose the pace, the size, and the composition. In QE phases, they behaved like a very large, very patient asset manager buying duration and credit risk when nobody else wanted it. They are also allocators. They allocate not just capital, but confidence. When they decide to reinvest maturing bonds, or let them roll off, they're deciding how much duration the private sector has to absorb. When they choose between treasuries and MBS, they're allocating support between the federal government and the housing market. When they signal the path of rates alongside that balance sheet plan, they're effectively choosing which parts of the capital structure they are willing to stress. And they are constraints themselves, because every decision they make is constrained by three things: political tolerance for pain in markets and the real economy, the plumbing of the financial system, reserve requirements, money markets, bank balance sheets. Their own credibility. They must look in control even when they're improvising. For a long time, what worked was simple: grow. Grow the balance sheet when there's a shock. Buy treasuries, buy MBS, keep overnight rates anchored. Markets came to see the Fed as a backstop. Whenever something broke, the Fed would expand again. It was asymmetric. Expansion was rapid and aggressive. Shrinkage, when attempted, was tentative. That regime worked in the narrow sense that crises didn't spiral into depressions, and asset prices recovered. It allowed governments to run bigger deficits at lower apparent cost. It rewarded duration, growth, and financial assets generally. What quietly stopped working was the assumption that this balance sheet could be shrunk at will, on a timetable, without meaningful side effects. Every time the Fed tries to reverse course, by letting bonds roll off, by stopping reinvestments, by stepping back from the MBS market, it collides with the realities the journal is highlighting: demand for safe assets, the sensitivity of risk assets to liquidity, and the political constraints around tightening financial conditions too much, too fast. So where is the inflection point? The inflection point described in this article is the moment when we should shrink meets we can't easily shrink without breaking something. Strategy, incentives, and environment all shift. In the past, the Fed could talk about normalizing the balance sheet to pre-crisis levels. That implied going back to a world where reserves were scarce, the central bank's footprint in bond markets was small, and private capital did most of the absorbing of government. The expectation was that large-scale asset purchases, QE, would stabilize markets, compress term premiums, lower long-term yields, and support risk assets. That part worked. Liquidity was restored. Credit spreads narrowed. Asset prices recovered. The unstated expectation was that this expansion could later be unwound in a controlled way, back toward some normal size. What actually happened? The balance sheet became semi-permanent infrastructure. Each crisis layered on a new plateau. Post-2008, post-Eurozone tension, post-pandemic, post-whatever came next. Shrinkage attempts were small relative to the prior growth and often had to be paused once markets showed signs of stress. Opportunity cost? By using the balance sheet as the primary shock absorber, the Fed arguably suppressed some of the natural market discipline that would have repriced risk earlier and in smaller increments. Investors learned to assume that deep drawdowns would be met with renewed buying. This shaped capital allocation wildly, toward duration, toward growth, toward leverage. Hidden trade-off? The larger and longer the expansion, the more the Fed's portfolio overlapped with private portfolios and the government funding machine. The Fed ended up owning a massive share of outstanding treasuries and mortgage bonds, which made the path of normalization itself a systemic risk. Most failures come from success carried too far. The success here was QE as a stabilization tool. Carried too far, it created an exit problem. Decision 2. Commit publicly to shrinking the balance sheet. What was expected? Communicating a plan, caps on runoff, timelines, endpoints, was supposed to anchor expectations. Markets would know what to expect. The Fed would regain optionality. What actually happened? Each time the Fed talked about or implemented shrinking, markets began stress testing the plan in real time. You'd see volatility in rates, repricing in equities, dollar strength, and pressure in funding markets. The more explicit the plan, the easier it became for markets to front-run the consequences. Opportunity cost. The Fed's communication bandwidth got used up on explaining its balance sheet, leaving less room to be flexible. If they deviated from the plan, credibility was questioned. If they stuck to it despite stress, they risked tightening too much. Hidden trade-off? By turning the balance sheet into a primary policy signal, they made it harder to treat it as a quiet, background tool. The article's title, Shrinking Fed is Easier Said Than Done, is really about this. Saying you'll shrink is cheap. Actually shrinking in the face of market and political pressure is costly. Decision 3. Composition choices. Treasuries versus MBS. Opportunity cost? Capital, both real and psychological, was steered into housing as a Fed-supported asset class. That's not necessarily bad, but it created expectations that the Fed would always be there in size. Hidden trade-off? Exiting MBS is not just a technical choice, it's a reallocation of who bears mortgage risk. That reallocation has distributional and political implications that feed back into how far and how fast the Fed can really go. Now, let's make the visuals in this journal article vivid in your mind, because they're the evidence. On screen, I'd have us show the key chart the piece relies on, a line tracking the Fed's balance sheet over time, rising sharply in crisis episodes, flattening a bit, then rising again. The y-axis is total assets, trillions of dollars. The x-axis is years, running through those major episodes. As you look at it, you see steps, not cycles. A big jump in 2008-2009, a plateau. Another jump around the pandemic, another plateau. That chart is measuring the stock of assets the Fed holds, not a flow, a stock. Why it matters? It shows visually that shrinking is against the grain of the last decade and a half. The base state is large. What most people miss is that each plateau embeds a whole market regime. Bank reserve habits, dealer inventories, money market fund structures. To move down that staircase isn't simply to hit reverse, it's to rewrite those regimes. If there's a second chart, I'd have it show the relationship between the Fed's balance sheet and something like the S&P 500 index level or a broad measure of financial conditions. Two lines, one representing total Fed assets, another representing a proxy for market ebullience. As the Fed's line steps up, the market line trends higher. As the Fed pauses or hints at shrinking, you see wobbles. What's being measured here is correlation, not causation, but the visual is powerful. It matters because it's how investors think. Liquidity up, risk up. What the chart's creator is really saying is, you can't talk about valuations without acknowledging the background liquidity regime. If the article includes any table summarizing the composition of Fed holdings, say Treasuries versus MBS, you'd see columns, type of asset, current holdings, share of total. That table measures concentration. It matters because it shows where the Fed is most entangled with private markets. What people miss is that even if the aggregate balance sheet shrinks slowly, shifting composition can still be a big shock for specific sectors, like housing. Now for the reality check. The uncomfortable truth the journal is surfacing is that the Fed's balance sheet is no longer just a cyclical tool. It's structural. Shrinking it meaningfully is not just a question of will, it's a question of whether the rest of the system can absorb the assets, tolerate higher term premiums, and live with tighter financial conditions without forcing the Fed back in. Lesson 1. Incentives shape the size of the safety net. Politicians like low borrowing costs and buoyant markets. Market participants like liquidity and backstops. The Fed has its own institutional incentive to avoid being blamed for crises that could have been solved with more balance sheet expansion. Put those together, and you get a one-way bias toward growth in the Fed's portfolio. Any plan to shrink has to fight those aligned incentives. Lesson 2. When scale becomes enormous, flexibility shrinks. A small balance sheet can be moved around quietly. A multi-trillion-dollar one cannot. The larger the Fed's asset book, the more every marginal change ripples through yields, funding markets, and political debate. At that scale, optional tools become locked-in infrastructure. For investors, that means you can't assume the Fed will ever fully vacate the market. You have to assume a permanently larger central bank footprint. Lesson 3. Success plants the seeds of failure when it encourages fragile behavior. QE worked. It stabilized markets. But repeated success encouraged more leverage, more duration risk, more moral hazard. That's why even modest QT rattles markets. Systems must evolve beyond the mindset that the central bank can always step in without consequence. So what's the core question this Wall Street Journal article is raising? It's asking whether a central bank that has become a dominant player in its own bond market can genuinely go back to being small without destabilizing the very system it's supposed to protect. My answer, as a value investor reading this, is that shrinking the Fed will likely be a slow, partial, and reversible process. The balance sheet may fluctuate, but the era of a permanently tiny central bank footprint is probably over. That has implications for how we think about risk-free rates, equity risk, premia, and the types of businesses that deserve our capital. And the sentence I'd want you to remember for years is this. Whenever you hear that the Fed will easily unwind its giant balance sheet, remember that the hardest portfolios to shrink are always the ones that made everyone feel safest on the way up. This is Avi. Like and subscribe. On to the next.